Okay, guys, so the markets are red. Everyone is panicking. We've had Bitcoin pull down from 100K plus down to 92, 93,000. But there are still ways to make money in DeFi. And I'm going to show you in this video how some of the smartest players are investing in order to hedge themselves and still generate cash flow. Let's dive into it. Guys, so there are two particular strategies I want to outline in this video. And if you're looking for a deeper dive into these two specific strategies, make sure to comment "beat the bear" in the comments below this video, and we will get you access to the deeper dive into this. But these two strategies have been able to help a lot of our members and fast track clients make sure that they have been able to hedge themselves here over the past couple of weeks in the market with things pulling back. And very interestingly, we did a very extensive deep dive into this particular strategy I'm about to show you on October 9th, right before that October 10th flash crash in the markets. And so I'm hoping this is going to be useful for some of you here today. So first and foremost, the first strategy I want to talk about is our delta hedging strategy, where effectively when we enter a liquidity pool, and I'm assuming here that we're operating with a pool at a concentrated level, and I'm using Solana USDC as the example, from 130 up to about $202. So this is our concentrated range where we're providing liquidity. And for all intents and purposes, let's just say that we entered this pool back when Solana was right around the middle of this range at $165. We didn't anticipate, or we didn't know the price was going to drop from 165 all the way down to 130. A very strategic way that you can hedge yourself when you set up this type of liquidity pool is by using a perp short at the moment of entry in order to cover your deltas so that you don't have too much long exposure. Remember, when we're providing liquidity into a liquidity pool, we're technically taking on long exposure to the volatile asset in that trading pair. In this example, it is Solana because we're providing liquidity to Sol versus USDC. And if we zoom out here and just take a $10,000 example, let's say that we went into this particular pool with 10,000 US dollars at the time of entry, and that we went in with a 50-50 split in the middle of the range when Solana was priced at $165. We know from providing concentrated liquidity, 50% of our capital is going to be allocated into USDC. So that would be $5,000 allocated into USDC. And then $5,000 is going to be allocated to Solana. And so at a price of $165, dividing that by 5,000, that means that we had roughly 30 Solana of exposure in this liquidity pool when we entered it and opened it at a price of $165 per Solana. Very simply, all you have to do is divide $5,000 by the price of Solana upon entry. That gives us 30 Solana of exposure. Okay, now here is the key part. This is our long Sol deltas as part of this setup. Now, there is more detail you need to understand about the overarching mechanics of this strategy. So like I said, make sure to comment "beat the bear" below and we'll send you the updated, more extensive video. But if you want to be delta hedged at the moment of entry, what you can do is you can use a perp dex just like Jupiter in order to short the equivalent amount of Solana that you are long in your liquidity pool. Okay, we just calculated that upon entry, we had about 30 Solana worth of exposure in this liquidity pool. So if we want to be delta hedged, what we need to do over here on Jupiter, for example, is create a perp short where we are shorting 30 Solana in order to hedge the exposure we have in our pool. Now, the benefit of using a perp dex like Jupiter is that you can be very capital efficient with the way that you're hedging away these deltas. Okay, you know that it cost us $5,000 to take on roughly 30 Solana of exposure in this pool. But over here on Jupiter, if we're going to use 2x leverage, we should only need about $2,500 worth of exposure with 2x leverage in order to short the equivalent amount of Solana. Okay, so as you can see, by using $2,500 of my own capital and 2x leverage, that is allowing me to short just under $5,000 worth of Solana. So that short position of shorting $5,000 worth of Solana effectively cancels out this 30 Solana of exposure that I have over in my pool and makes me pseudo delta neutral upon entry. Okay, this is how you can hedge the downside, because what this means is as the price of Solana drops, yes, you're technically losing US dollar value in your pool, but you are also gaining US dollar value from the perp short that you set up. And if Sol moves from 165 down to 130, you are in a very nice profit from your perp short. Okay. Again, I don't recommend using too much leverage. I prefer to use 2 to 3x leverage with this particular strategy. But hopefully, you're understanding that it's not going to be perfect, but the long sol deltas that you have in your pool are going to be canceled out by the short Solana deltas you have in your perp short, allowing you to dampen the amount of losses that you have on the downside and remain pseudo delta neutral. Now, remember, there are more intricacies as part of that strategy. So if you want the full breakdown, make sure to comment Beat the Bear in the comments below and we will get it over to you. But the other strategy that you could use in order to hedge your risk on the downside, because remember, ultimately, none of us know exactly what's going to happen here in the markets over the next 24 hours, let alone 24 weeks. And so the other strategy you could consider is setting up something like an insurance policy. And again, we've done lots of content on this, but we do share an even deeper breakdown in the video I'm mentioning. So comment down below, guys. But what you can do is you can create a limit order on the perp dex so that by the time price actually gets right to the bottom of your range here, and in this example, that is around $130, we can set up a limit short position over on a perp dex using the limit function, specifying that we don't want to actually trigger the limit order until the price of Solana reaches below 130, i.e. $129. At that point, we trigger the perp short to actually execute with that limit order, and then we can short however much Solana that we have exposure to in the pool at that moment in time. Now, remember, in the previous example, we said that we had 30 Solana upon entry, and we had about 5,000 US dollars in the pool. By the time you get down to the bottom of this range, you're probably going to have something closer to almost 60 Solana. And so by the time you actually go out of range on the pool, you might have closer to 60 Solana. And so you might actually want to be going ahead and creating a short for the equivalent amount of Solana over here with your perp short. Okay. Again, maybe that means using $5,000 of your own capital in order to short 10K worth of Solana by the time price reaches 129. And then from that moment onwards, after price exits the bottom of this pool, you're already 100% converted into Solana from the pool, but your perp short triggers executing that insurance policy. And it means that if price does keep dropping lower, let's say from 130 down to something like $95, your perp short is in profit all the way down, making sure that you have that insurance policy, hedging that risk of price moving lower in US dollar terms, and then you can close out that perp short for a nice profit. Okay. Hopefully this is making sense, guys. Remember, you have to understand all of the mechanics at play here. Maybe you haven't done perp shorting before. Maybe you haven't really understood these concepts in a huge amount of detail. So make sure to comment below. We have a much, much deeper dive on these two specific strategies we want to share with you. Comment Beat the Bear in the comments below this video, and we will get those over to you. But for all intent and purposes, it's very, very possible to generate cash flow in a sideways and bear market. And of course, nothing here is risk-free, but once you know these strategies, you have these strategies in your toolkit, that means that you know and have them as part of your arsenal, and you can execute them when the time is right. Okay. You don't have to be sitting on your hands and waiting just to make yield when markets are moving sideways and down. You can use these strategies in your toolkit, use them when the time is right, create those insurance policies, create those delta hedge positions to ensure that you mitigate risk on the downside and continue generating cash flow. That is it for today's video, guys. Comment below. Like I said, Beat the Bear. We will send you that breakdown and that guide to show you these strategies in detail so that you know how to execute them. And this is not just for Solana. This works with Bitcoin, Ethereum, SUI, other assets that you are bullish on fundamentally for the medium to long term. Comment below this video. We'll get that over to you, and I'll catch you in the next one.